Change in state of delivery, or CISD for short, is the moment when the strength of market movement suddenly shifts. This is when a bullish movement that looks strong suddenly turns bearish, or vice versa. This sharp change is often the first signal of a potential market reversal. And for traders who are alert, this is a golden opportunity, an opportunity to enter the market with a very favorable risk and reward ratio. In this video, we'll break down the CISD concept in detail, including how to spot it on the chart and, most importantly, how to use it to get high probability entries. Get your coffee ready, because this will be one of the most mind-opening topics on your journey to understanding the ICT method. So what does CISD actually mean? CISD is a reversal pattern that happens suddenly. Unlike a typical retracement, this is a decisive shift in momentum when a market that was previously moving up strongly suddenly loses momentum and reverses direction with significant force. For example, imagine we're observing a short-term bullish movement. The last 3 candles show a strong push upward, even breaking through the previous swing high. This is a clear signal of buy-side delivery, a condition where large institutions aggressively push prices upward. At this stage, we can mark the body of the first candle as the starting point of that bullish movement. However, when strong bearish pressure suddenly appears and breaks through that line, it becomes an important signal that there's a shift in dynamics or an early sign that the direction of distribution is starting to change. Here, it means that the price has refused to continue the main trend, and the previously strong buyer momentum has been completely stopped by seller pressure. This is what's called a change in state of delivery, or a shift from buy side to sell side. So, what does CISD actually mean in the context of price action? First, we need to understand one thing. The breakout that previously looked strong turned out to be just a fake out. The goal is to attract liquidity from retail traders who place positions above the last swing high. The buy-side delivery that previously pushed the price up is actually triggering a liquidity trap, sweeping up stop losses and limit orders placed there. And not long after, the price instead drops sharply. When the price breaks through the starting point of the bullish candle, or the area we've identified as buy-side delivery, that's an important sign that buyers have failed to maintain market dominance, and now it's the seller's turn to start taking control. So the question now is, how can we use this concept to enter a position? After a valid candle closes below the initial level of buy-side delivery, the price bias now shifts to bearish. And in this kind of situation, our focus is just one thing: looking for opportunities to sell. And when the price retests the CISD area, that's where the best opportunity to enter appears. The change in state of delivery concept also applies in the same way in a bearish scenario. This time, we're looking at a market that was previously under bearish pressure, with prices continuously forming lower lows and showing seller dominance. But an important moment happens here. After a liquidity sweep occurs at the last low, the price suddenly reverses direction and moves upward. Because of this, we can identify that this bearish candle is the sell-side delivery area. This change signals that the sellers have lost control, and this is the first indication that the market has the potential to reverse and go up. But a lot of people are still confused here because many think CISD is the same as change of character. In fact, the two have quite fundamental differences. Change of character happens when the price breaks through the main market structure, for example, breaking a lower high in a bearish trend. Usually, this serves as the initial confirmation of an overall trend reversal. Meanwhile, change in state of delivery focuses more on sudden shifts in momentum before the major structure is actually confirmed to have changed. That's why CISD often gives an earlier signal compared to change of character. In other words, CISD is an early clue that something is off with the previous direction. But it's important to remember, not every CISD pattern that appears on the chart can immediately be considered an entry opportunity. If this pattern forms in an area where the structure is unclear or outside the context of market movement, then most likely the results won't be optimal. Based on the backtests I've done, the CISD pattern is much more accurate when it appears under certain conditions. And there are 2 important rules you must pay attention to before using CISD as an entry signal. First, the reaction at key areas on a higher time frame. Because CISD is a reversal signal, its strength will be much greater if it appears in a key zone on a higher time frame. For example, the price touches a support area on the daily chart. Then on the H1 chart, a CISD formation appears in that zone. Now that can be a signal that the market is ready to reverse direction. On the other hand, if CISD forms in the middle of momentum without support from the higher time frame structure, it could just be a regular retracement and not a true reversal. Second, there must be a liquidity sweep first. A high probability CISD usually appears after the market sweeps a liquidity pool. For example, when the price sweeps stop losses by breaking through an equal low, it means the market is taking liquidity. Well, after that process is complete, the price usually starts to reverse direction. And this is where CISD often appears. Then, pay attention to the volume and momentum confirmation. To make sure that the CISD pattern that appears is truly valid, it's not enough to just look at the shape of the candle. We also need to pay attention to one important element, which is momentum. When there is a significant price change and the volume also increases sharply, it means that many big players are involved in that movement. One way we can identify momentum supported by large volume is through the appearance of a fair value gap, or FVG. This FVG forms when there is an imbalance between aggressive buying and selling pressure, causing the price to move too quickly and leaving a small gap between the candles. So, if you see a CISD pattern appearing at the same time as an FVG forms, that's a strong signal that smart money is involved in that movement. And of course, that makes the setup that forms much more credible. Lastly, wait for a pullback to the level that has already been broken. After we see the price break through the initial level of the CISD movement, don't rush to enter a position. This is exactly where it's important for us to wait for a retest. The retest serves as the final confirmation that the level which previously acted as a price push point has now changed its role. In a bearish scenario, think of the old support turning into new resistance. And in a bullish scenario, the old resistance turns into new support. And entering a trade after a retest to that level usually has a much higher probability, because the market has already shown its intention, and we just need to wait for the price to touch that area again before moving in the next direction. Now that we understand what the chain instead of delivery pattern is and know the important rules for using it effectively, it's time to get to the most exciting part. We're going to see how the CISD pattern works. And for this example, we'll use the Euro-USD chart on the 15-minute time frame. However, it's important for you to understand that the CISD formation can also be applied to various pairs such as Forex, commodities, cryptocurrencies, or indices. Here, the bearish market structure is clearly visible. The price has just broken through an important support level that had been tested several times before. If we focus on the last impulsive move, we can see a very strong downward push, even forming a fair value gap. This is a signal that sellers have managed to take control of the market and successfully push the price down through that key level. In situations like this, we usually anticipate a pullback to the support area that has now turned into resistance. And from a price action perspective, that's the ideal spot to open a sell position. But what actually happened was the opposite. The market started to show aggressive bullish movement. Several bullish candles formed, accompanied by the appearance of a new fair value gap, and eventually the price broke back above the key level. This is the momentum that catches our attention. This sudden shift in momentum is a hallmark of chain instead of delivery. Not only that, but the breakout that happened earlier turned out to be just a fake out. The goal is clear: to perform a liquidity sweep below the key level area. So how should we respond to a situation like this? According to our trading plan, we start by marking the open candle that represents the sell side delivery, because that's an important level we need to pay attention to. When the price returns to that area, we can use that level as the buy entry point. But before actually entering a position, check the market context on a higher time frame. For that, we'll zoom out the chart to the 4-hour time frame to see if this upward movement aligns with the larger trend. And sure enough, on the H4 time frame, we can see that the price has just touched a resistance turn support level. In other words, the analysis on the H4 time frame actually strengthens the bullish signal we saw earlier on the M15. Based on this analysis, we can start to put together a plan. We will place a buy limit a few spreads above the CISD line. We'll set our stop loss below the key level, aiming for a minimum risk to reward ratio of 2 to 1. And this is how we effectively apply the CISD pattern with momentum confirmation, support from the higher time frame, and a price action approach. Now you understand how chain instead of delivery works as a high probability entry strategy. But remember, understanding without practice will only remain theory. So make sure you backtest this concept and find the best version that fits your own trading style. If you feel this video has given you a new perspective on how the market works, help me keep sharing educational content like this by clicking like and hitting subscribe. Because there are still many more in-depth topics we'll discuss in upcoming videos.